Hello! Welcome to Capital Sensei. Today, we're going to dive deep into a modern classic of personal finance. Tony Robbins' Money, Master the Game. This isn't just a book summary, it's a breakdown of a 7-step blueprint designed to take anyone from any starting point towards true financial freedom. We'll explore the power of compound interest, expose the hidden fees that are quietly eating your retirement savings, and even look at a specific investment portfolio designed by one of the world's greatest investors to thrive in any economic weather. Before we jump in, a quick note. Whenever we can, we answer questions in the comments. Finance can feel personal and sometimes confusing, so don't hesitate to share your thoughts, your doubts, or even your own financial journey. Your story might be the exact thing someone else needs to hear to get started. And your questions help us all learn together. Let's get started with the very first and perhaps most important step Tony Robbins lays out. It's not about picking a stock or opening an account. It's a mental shift. You have to make the conscious decision to become an investor, not just a consumer. Think about it. Most of us are trained from a young age to be excellent consumers. We work for money and then we spend that money on things. An investor, on the other hand, makes their money work for them. They are no longer just trading their time for money. They are putting their money into the game to earn more money. It's like the difference between buying apples at the grocery store for the rest of your life versus deciding to buy a small piece of the orchard. When you own the orchard, the trees work for you day and night, growing more apples. Your money, when invested, acts just like those trees. It becomes an employee that never sleeps, never complains, and never takes a vacation. The goal is to eventually have enough of these money employees so that you don't have to be the primary one working anymore. To do this, you need to start funding what Robbins calls your Freedom Fund. This is a dedicated account for investing and nothing else. You don't rate it for a vacation. You don't dip into it for a new car. It has one job: to grow. You have to decide on a specific percentage of your income, no matter how small it seems at first, that you will automatically transfer to this fund. 5%, 10%, 15%. The number is less important than the act of starting and being consistent. This is where the magic of compound interest comes into play. Albert Einstein supposedly called it the eighth wonder of the world. Here's a simple way to understand it. Imagine you invest $100 and earn a 10% return. You now have $110. The next year, you don't just earn 10% on your original $100. You earn it on the full 110. So you earn $11. It seems small, but over decades, this effect snowballs into an avalanche of wealth. Time is your single greatest asset, more valuable than having a lot of money to start with. The second step is to become an insider. You need to know the rules of the financial game because, frankly, the game is often rigged against the average person. Robbins interviewed dozens of the world's most successful financial minds, and they all pointed to a few key myths that keep most people from winning. The biggest myth? That the fees you pay on your investments are small and don't matter much. This is a catastrophic misunderstanding. Let's look at a typical mutual fund, which might charge a fee of, say, 2% per year. You might think, 2%? That's tiny. But that's not 2% of your profits. It's 2% of your entire balance, year after year, whether you make money or lose it. Let's run some numbers. Imagine you and your friend both start with $100,000 and earn an average of 7% per year for 30 years. You invest in a fund with a 2% annual fee. Your friend, however, finds a low-cost index fund with a fee of just 0.5%. After 30 years, your friend's account would have grown to roughly $609,000. Your account, with that seemingly small extra 1.5% fee, would only be worth about $432,000. That tiny fee cost you over $177,000. It didn't just take your money. It took all the money that money would have earned over 30 years. Fees are a virus that compound against you. Another huge myth is that your financial manager can consistently beat the market. The data on this is overwhelmingly clear. Over any long-term period, like 10 or 15 years, more than 90% of actively managed mutual funds fail to outperform their benchmark. A benchmark is just a standard for comparison, like the S&P 500, which is just a basket of the 500 largest companies in the United States. Think about that. You're paying high fees for the supposed expertise of a professional stock picker who 9 times out of 10 would have gotten you a better return by simply buying a low-cost fund that automatically tracks the market average. This leads to a crucial piece of practical advice. You need to understand the difference between a broker and a fiduciary. A broker is typically paid on commission. Their legal obligation is simply to recommend products that are suitable for you. A fiduciary, on the other hand, is legally and ethically bound to act in your best interest, period. It's like the difference between a car salesman who wants to sell you the car that gets him the biggest commission and a trusted mechanic who tells you which car is genuinely the most reliable and best for your specific needs. When you seek financial advice, you should always ask, are you a fiduciary? If they hedge or can't give you a straight yes, you should be very, very cautious. The third step is to make the game winnable by defining exactly what winning means for you. Financial freedom is a nice phrase, but it's too vague. You need a concrete number. How much money do you actually need to be free? Robbins breaks this down into 5 levels, and this is where it gets really empowering. The first level is financial security. This is the absolute base. It's the amount of money you need per month to cover your most essential expenses: your mortgage or rent, your food, your utilities, your transportation, and your insurance. That's it. Take a moment and actually calculate this number. You'll likely be surprised at how much lower it is than your total monthly income. This is your first target. The day your Freedom Fund can generate this amount of money for you each month through its earnings, you've bought your basic freedom. You'll never have to worry about putting a roof over your head or food on the table again. The second level is financial vitality. This is your financial security number plus a little extra for the fun stuff. It includes half of what you currently spend on entertainment, small luxuries like new clothes or eating out. This is the level where you're not just surviving. You're starting to live a little more comfortably on your own terms, without having to work for it. The third level is financial independence. This is the big one for most people. It's the point where your investment income completely replaces the paycheck from your job. If you achieve this, working becomes a choice, not a necessity. You can decide to keep your job because you love it, switch to a lower-paying but more fulfilling career, or stop working altogether. You are now the master of your own time. Beyond that, you have financial freedom, which is independence plus the ability to afford 2 or 3 major luxuries, like a dream vacation home or a boat. And finally, there's absolute financial freedom, where you can essentially do anything you want, anytime you want, without ever thinking about the cost. But the key is to start with that first achievable goal: financial security. Knowing your number transforms a vague dream into a concrete mathematical mission. Now for step 4, which Robbins calls the most important investment decision of your life: asset allocation. This sounds technical, but the concept is simple. It's not about trying to find the one magic stock that's going to go to the moon. It's about deciding how to slice up your investment pie. How much goes into stocks? How much into bonds? How much into real estate or other things? The research is clear. Over 90% of your long-term investment results will come from this decision, not from picking individual winners. Think of it like building a championship sports team. If you only hired the best goal scorers, you'd have a terrible team. You'd get scored on constantly. You need defenders, a goalie, and midfielders, each playing a different role. In your portfolio, stocks are your offense. They're there for growth, for scoring points, but they can be volatile. Bonds are your defense. They are generally more stable, they provide income, and they protect your portfolio when the stock market goes down. Robbins simplifies this by talking about two main buckets of money. First is the security bucket. This is the defensive part of your portfolio. It's filled with lower risk, lower return investments designed to protect your principal. Things like bonds, and in some specific cases, annuities, or even just high-yield savings. Its job is to ensure that even in a crisis, you don't lose everything. The second is the risk and growth bucket. This is your offense. This is where you put your stocks, real estate, commodities, and other assets that have the potential for much higher returns, but also come with higher risk. The core question of asset allocation is what percentage of your money you put in the security bucket versus the growth bucket. A younger person might have more in the growth bucket, while someone nearing retirement might have more in the security bucket. But everyone needs a mix of both. You need both offense and defense to win the game. This brings us to step 5, which is creating a lifetime income plan. It's one thing to talk about asset allocation in theory, it's another to have a concrete strategy. For this, Robbins went to Ray Dalio, the founder of Bridgewater Associates, one of the largest and most successful hedge funds in history. Dalio shared his firm's all-seasons portfolio strategy, which is designed to perform reasonably well no matter what the economic environment is, what he calls economic seasons. There are 4 basic economic seasons that can affect your investments. 1. Higher than expected economic growth, or a boom. 2. Lower than expected economic growth, or a recession. 3. Higher than expected inflation. And 4. Lower than expected inflation, or deflation. The all-seasons portfolio allocates money in a way that it has something that will do well in each of these environments. Here is the specific allocation. 30% of the portfolio goes into stocks, like an S&P 500 index fund. This part does well during periods of strong economic growth. Then, a massive 55% goes into bonds, but it's split. 40% goes into long-term U.S. Treasury bonds, and 15% into intermediate-term U.S. Treasury bonds. Long-term bonds do exceptionally well when growth slows down and during deflation. Intermediate-term bonds do better when inflation starts to rise. Finally, the last 15% is split equally between 2 assets. 7.5% goes into gold, and 7.5% goes into a broad basket of commodities. Why? Because both gold and commodities tend to do very well during periods of high and unexpected inflation, which is when traditional stocks and bonds can suffer. Look at the balance. It's heavily weighted towards bonds, which makes it far less volatile than a typical stock-heavy portfolio. Its goal isn't to hit home runs every year. Its goal is to never get knocked out of the game and to reliably grow your wealth across any economic season. For someone just starting out, this is a phenomenal template. It takes the guesswork out of asset allocation and provides a diversified, resilient foundation. You can implement this entire strategy yourself using just a few low-cost exchange-traded funds, or ETFs. Step 6 is where we learn to invest like the 0.001%. Robbins distills the wisdom of the billionaires he interviewed into a few core principles. One of the most powerful ideas is seeking out investments with asymmetric risk and reward. This sounds complicated, but it just means finding opportunities where the potential upside is many, many times larger than the potential downside. Think of it this way. A bad investment is one where you risk $100 to potentially make $10. A symmetric investment is risking $100 to make $100. An asymmetric investment is risking $100 for a chance to make $1,000 or even $5,000. The super wealthy are masters at finding these setups. They aren't just gambling. They are making calculated bets where they can't lose much if they're wrong, but can win big if they're right. For the average investor, this might mean allocating a very small portion of their portfolio, maybe 5%, to more speculative, high-growth opportunities, while keeping the core in a safe strategy like the all-seasons portfolio. Another key lesson from the ultra-wealthy is an obsession with tax efficiency. It's not just about what you earn, it's about what you keep. The government is your silent partner in all of your investments, and you want to minimize its take legally. This means taking maximum advantage of tax-sheltered retirement accounts. In the United States, this means things like a 401k or a Roth IRA. Let's quickly demystify those. A traditional 401k or IRA lets you invest with pre-tax money. You get a tax break today, but you have to pay taxes on the money when you withdraw it in retirement. A Roth 401k or Roth IRA is the opposite. You invest with after-tax money, so there's no tax break today. But here's the magic part. All of your growth, all of your earnings for decades can be withdrawn completely tax-free in retirement. For a young person with a long time horizon, a Roth account can be an unbelievably powerful tool for building tax-free wealth. Finally, we arrive at step 7, which is to just do it, enjoy it, and share it. This is about turning knowledge into action and connecting your financial goals to a deeper sense of purpose. The first part, just do it, is about automation. The single most effective way to ensure you consistently invest is to make it automatic. Set up an automatic transfer from your checking account to your Freedom Fund every single payday. Pay yourself first before you pay your bills, before you buy groceries, before you spend a dime on anything else. This removes willpower, discipline, and emotion from the equation. The system does the work for you. The second part is enjoy it. The journey to financial freedom shouldn't feel like a miserable life of deprivation. It's about conscious spending. As your Freedom Fund grows, it creates a sense of security and possibility that is in itself a huge reward. You're not just building a pile of money. You're building a life with more options, less stress, and more control. Celebrate the milestones along the way. And the last and perhaps most profound part is share it. Robbins makes a powerful case that true wealth isn't about what you accumulate. It's about what you can give. The secret to living is giving. When you have more than you need, building a bigger barn is less fulfilling than building a longer table. Incorporating giving into your financial plan, whether it's through tithing, charity, or simply helping others, connects your money to a purpose beyond yourself. It transforms the entire game from one of personal accumulation to one of positive impact, which is a source of joy that no amount of money alone can buy. Mastering money isn't just about getting, it's about growing and ultimately giving back.